Thanks, everybody. Great to be with you here to talk about Western markets. I had referenced this project a little bit for those of you who were at Nashville last year, but it was still ongoing, so couldn't give a lot of detail on it. And I think since then, we really have been, as E3, as our firm, really investing in our PLEXOS capability and the work that we've been doing with Exemplar sort of over the past year. Which included sort of finishing off this project and working on ways that we can use some of what we learned here in other contexts and other markets and other types of valuations. As Mark said, I'm Jack Moore. Before getting into this, I just wanted to make sure to mention that this project wouldn't have been possible without the work of the PLEXOS design and development by our team, which includes Chen Zhang and Jimmy Nelson, who are here today, as well as guidance on just the lay of the landscape within the Western market by Lakshmi Alagappan, our partner on this project. I was just going to say, sort of, from an E3 perspective, we have a tendency to make kind of analogies to the power system when describing sort of personal interaction. So I was thinking they were sort of getting into the time period to start deploying mental spinning reserves here. So yeah, if anybody needs to go and get black coffee or get coffee, a little bit of black start resource again, you're welcome to. Anyway, E3 is, I just want to give you a little bit of background on that. We have about 130 consultants now across our 4 offices, and we do work really in equal portion with industry leaders, really across the electric sector. So that includes policy work for state agencies on sort of public studies, as well as work for ISOs and utilities. And then finally for developers and investors, relatively in equal parts. And we have been using increasingly our production simulation capabilities in PLEXOS to deliver those products more recently. That includes as well a lot of relevant work on markets that we've worked on, both in the West as well as in other regions. We find that it's very useful to see what's going on sort of across the U.S. as well as in other countries, to be able to see sort of ideas and concepts that can be ported over and thought of for deploying in different markets. Just within E3, I usually talk to a lot of people who know one particular thing that we do, but aren't aware of the other areas that we work. So largely our work is divided into 3 different practice areas, one being climate pathways and electrification, which looks largely at sort of long-term ways to decarbonize and the effect that will have on loads and demand for electric power. Then integrated system planning, which looks all the way from the distribution level all the way up to transmission and generation planning, and works on sort of long-term portfolio optimization and build decisions related to that. And then finally, asset valuation and markets, which we use to work on diligence projects as well as evaluating and projecting market price forecasts for most of the North American markets and revenue that would sort of apply to particular resources that could dispatch to those prices. And as well, look at how market design issues could change and evolve over time. That's the group that I sit in, largely within E3, maybe relevant tonight. We sometimes talk about ourselves as Hogwarts houses. So the asset valuation of markets that we're in is the Slytherin, of course. So a little bit more financially focused than some of the other ones. Before I get into the markets side, I just wanted to say we have a lot of in-house tools as well as commercial software that we've used historically. I think one of the things that we've really been looking at investing in recently in terms of our attention and our time and been working more and more is using PLEXOS both on sort of an ST basis for dispatch as well as LT for system planning and procurement decisions within that context. We've been doing that more. But we've found that a lot of the other areas that we work in, like working with the LCCs or capacity value for different resources, can inform and serve as inputs into a lot of the PLEXOS evaluations that we're doing. As well as, I think within this project, one of the things that we used was our reserve model, which tries to calculate, given uncertainty of wind, load, and solar on a particular day, how much is sort of an optimal level of reserves to hold. And so it's sort of interesting to think about sort of the overall ecosystem of things used to create a really good representation of operations for cases that we're running. So jumping to Western markets, I think for those of you who are not very familiar with the West, I think one thing that's always important to call out is that this is a regional sort of efforts to have more regional coordination in the West is something that has had a long history. Going back really to the 90s, there have been efforts to try to create Western RTOs for some or all of the US West. Right now, California ISO and Alberta are the only areas that do have RTOs. But there are both sort of periods of sort of attempts and then unsuccessful sort of lull periods in there. But starting in about 2013, the California ISO did successfully start and has since then expanded over the last 10 years a real-time energy imbalance market, which is sort of real-time dispatch across a footprint that covers most of the West, except for most of the areas in Colorado and Wyoming, which are now covered by the Energy Imbalance Service, which is the real-time energy market offered by SPP. What's been sort of increasingly sort of prominent now is thinking about sort of extending that. And both of those markets have provided sort of significant benefits to those who have participated and generally been, I think, positive experiences for those involved. But it's made people think, can we extend this and think about the value this provide if we extend this to a day-ahead market and cover sort of a wider range of how people are committing and dispatching their resources over that broader footprint. So really in the last year, even the last 5 months, both CalISO and SPP have released separate tariff proposals for their new expanded day-ahead market and really real-time market options that different participants, different utilities in the West could opt into joining. And that would be the Extended Day-Ahead Market, or EDAM, and then Markets Plus by SPP. And we're in a period right now where probably sort of the 2026, 27 timeframe is when these could start to go live. But we're in a period now where a lot of the individual balancing authorities and utilities within the West are all independently trying to evaluate whether one of those two options would be good for them to get on board with and good for their customers and their overall systems. So that was really the impetus of our project here. I'd say one thing that is important to point out is that what we looked at for this project is one among a number of considerations that utilities and others would think about when thinking about whether one of these two day-ahead markets would be good options for them. I think we've focused mostly within the study on the operational savings. So it's sort of the things that are in bold on the left side. So things like reduced cost of energy, sort of lower cost purchases from neighboring jurisdictions, lower greenhouse gas, reduced curtailment. What we don't get into is the impact of a day-ahead market that it could have on build decisions, so capacity expansion decisions, which is definitely a significant amount of the overall cost of running the system. But it sort of takes into account other decisions that wouldn't be sort of just solely linked to the day-ahead market. As well, the West has a separate sort of parallel track to look at sort of regional coordination for planning, which would be the Western Resource Adequacy Program, or WRAP. Overall. But that's one consideration, as well as sort of joint transmission planning would be something that people talk about in terms of coordination and sort of broader coordination that would be deeper than just a day-ahead market. And I think as well, considerations that are sort of not quantified, but things like governance are definitely ones that weigh heavily, I think, in the minds of people who are choosing between these markets right now. But on to our study. So about a year and a half ago, a group of 26 of these utilities in the West got together and formed the Western Markets Exploratory Group, which got together to sort of collectively research the impact of development of one or either of these markets in the West. And so they hired us and Utilicast to study this and sort of lead investigation of this work. And so largely, the nature of our project, I think, can really be sort of summarized by looking at these maps. So what we were doing is essentially using an ST PLEXOS case and a series of them that I'll go into through in a minute to evaluate and compare basically the business as usual world in the West right now, which is essentially in a day-ahead time frame, which is on the far left. People make bilateral trades largely, either at like a couple of market hubs overall, or through calls and other messages and conversations, sort of entity to entity, but not through sort of an organized, collective, sort of optimized dispatch system. But then in real time, they each have the two real-time markets fully operating right now. So that's the EIM, which covers most of the West, and then the EIS, which covers Colorado and Wyoming. And what that is compared to, and what we studied and evaluated that next to, was different footprints of potential groups of participants of different utilities who would either join EDAM or Markets Plus. And so that's over on the right side. There are just two examples of cases we ran. One being an EDAM bookend, which would be a case that basically evaluates what would happen if you had pretty much the whole West or Western U.S. all together in one market. Or alternatively, if you had a case where you split up the West into sort of two different groups, some joining Markets Plus, some joining the EDAM, and compared sort of what happened within that arrangement. I think one thing that's important for that, the split footprint that we've shown an example is one that we've presented results on for individual utilities in different forums, in different public forums, but largely the one that we sort of chose to evaluate and highlight, I think, for some of these studies was a main split case, which had California, all the California zones, including LA and SMUD and EDAM, as well as Pacificor, and then everyone else in Markets Plus. But that's just sort of one among a number of different potential permutations that could play out over the next year as different entities make their decisions and start to lock that in. I think one thing that's really important that we highlighted in this study, but I think it was important to be mindful of, is that both of those footprints on the right side really apply both to the day ahead as well as the real-time stage. And so it is sort of maybe more consolidation at the day ahead level, but potentially, depending on the footprint, sort of a little bit more separation in real time compared to where we are today. From an implementation standpoint, there were really four challenges that I really wanted to highlight for this that our team had to wrestle with. So the first was essentially how to reflect the impact of forming a day-ahead market relative to the existing world where you already have a real-time market in place. And so sort of what's incremental versus what's sort of just the total value of markets. Secondly, we needed to look at and reflect, to the extent possible, the distinct features of the proposed markets that we had. The tariffs, they weren't fully known at the time, but it's definitely clear that there's some aspects within the EDAM tariff and the Markets Plus tariff that are unique and that could affect benefits to particular entities in different ways. And so we tried to dig into that to the extent possible. We also wanted to reflect not just system-wide savings, which is definitely important and an interesting number, but really the decisions by each entity is really which one's better for them. And so what we tried to evaluate instead was, and we had the challenge of evaluating, was how those impacts each participant individually. as an entity and for their customers and their loads and their generators. And so last of all, just how to complete all this. We had about 8 months in sort of total time to acquire data and set up cases and run all the cases, which was pretty ambitious for working with a lot of different entities altogether versus sort of a multi-year stakeholder process. So the way that we approached this largely that our team did is in looking at, we knew that we needed to be parsimonious. We needed to reflect the details that were really important for evaluating some of these distinctions between the two markets and between those markets versus how we operate today, but not add in too much that it would just sort of create distraction or sort of create too much time that we would face a challenge in sort of accomplishing and completing the study in that time. So within that, one of the things that I think definitely helped our efficiency was running this in cloud. It allowed us to run a lot of cases in parallel and get, over 4,000 cases completed over sort of the last couple of months of the study when you include sort of each one being an 8760 for the overall West. And we're really happy about that. But in terms of sort of the structure, what we did is we had sequential model runs where we would run basically a day ahead stage and then take some of the output of that stage, such as the commitment of fast start units, and pass that down to the real-time stage. And so some decisions are frozen that you take from the day ahead and you pass down to the real time, and then we'd run the real time sort of a second pass. And the difference being, so if we think about the business as usual case, in the day ahead we have friction that characterizes sort of the wheeling charges as well as just the challenges to sort of finding deals that are appropriate in today's bilateral world. Whereas when we go to the real-time case in the business as usual, we've got the EIM and EIS facilitating more optimized dispatch between the different entities participating. The other thing that I think is important to note, though, as well, is that not everything settles in real time. So it's, in terms of sort of the dispatch of the system, that's the thing that really does happen in reality. You know, the day ahead is sort of conceptual or sort of on a planning basis. But in terms of the financial impact, all transactions that a different entity does at a day ahead level, actually, those are real. And so any purchases or sales made based on what one expects to be able to dispatch and one expects to be able to know at a day ahead level do affect sort of the final characterization of how much cost any of these worlds creates for a particular entity involved. I think we ran separate sort of sequential stage runs for the other markets, and I think one thing to note, each of EDM and Markets Plus had distinct features modeled for the particular markets. I think one that I really wanted to highlight within this was for the day-ahead market run in the Markets Plus footprint, one feature of Markets Plus that we wanted to represent was the fact that they have proposed fast start pricing, which is currently applied in SPP's own market in the Eastern Interconnection. For those not familiar, what fast start pricing essentially is a different way to ex post evaluate what the energy price is for settling purchases and sales of different entities, basically, generation revenue as well as the cost to loads for a particular jurisdiction. So what that means is that if you think about it, the market optimization will be making kind of unit commitment decisions of whether to bring on a fast start unit or not based on the start cost of that unit. But that's usually a larger cost that doesn't sort of, in a normal pricing structure, usually won't be what is the price that goes into the LMP or the marginal price that's used to settle all energy. So this takes an ex post approach that instead takes that and converts that start cost for fast start units, if they did start up at a particular hour, to a dollars per megawatt hour adder that then is applied to the energy prices, which then propagate to everyone else participating. So it provides a little bit more incentive and reward for those who do have flexibility in the market to be able to get more revenue for their resources that are able and capable at doing that. But we had a really good experience working with Tarek at Exemplar and Chuck and their team to create some customizations within the framework to be able to sort of pass variables and sort of freeze certain aspects of it to be able to really characterize that fast start pricing aspect. In terms of results that we saw, I'll just go through this at a high level. I think first, for the EDM bookend case, overall, we saw $60 million of savings for all participants. And that was from a mix of, what we saw was it's a really wide variation among the different WMEG members that we evaluated. So each of these bars are savings or cost increases for each individual entity. And there's some with sort of significant savings and some with significant increase in cost relative to BAU. And that's largely because of the impact of pricing of these markets and these day-ahead markets of sort of changes in how entities transact and get revenue for some of the resources. Separately, for the main split footprint, which was that split footprint that we should have mapped on before, there was interestingly actually an increase in cost relative to the BAU case. And this was, I think, driven by two factors. One is that the BAU case has that sort of fairly wide footprint set of real-time markets already included. And so that was sort of being broken up, and there was a seam essentially between the markets plus and the EDM footprint that sort of goes into place here with a cost that we impose to get sort of and transact between one of those markets and back and forth. But I think the other interesting thing with this, which means that there's a lot of sort of individual thinking to do for each of the utilities that we worked with that group, is that there was, again, a really wide range of cost savings or increases in costs depending on the entity and their location, as well as sort of their net position of resources and loads. Two quick things that I'll just add within that that were sort of other features that we noticed within this. One was that the study really highlighted, depending on the footprint, that additional transmission potentially could be valuable. We found, particularly with the main split footprint, there was a lot of congestion going from the northwest down to the southwest and vice versa to sort of have transactions that stay within that markets plus footprint. And that caused often pretty sizable price spreads between the northwest zones, which had relatively flat prices in a lot of months, and the southwest, which had much more peakiness. And that's even more so than even in a business as usual world today. And the other thing that I think we highlighted from this study that I think is really important to think about, and we've been digging into a lot more, is market-to-market coordination. I think this is an issue that everybody there's sort of says words about, but really trying to think about how does that work to get two markets, either at a day-ahead or real-time level, to have relatively close optimization between them. What we showed just conceptually is that if you reduce the hurdle rates between these two zones, you can have a sort of significant amount of savings compared to having sort of a more costly seam for making transactions between these two regions. But I want to save time for questions, so I can go to that if people are ready.
I think you kind of alluded to it, but I might have missed the detail. Like, what were the factors or what were the inputs in the day ahead that you fixed versus what then varied in the real time? And then and then like in the real time, you mentioned, say, like the 4,000 runs. Like, were there some like stochastics around the real time to vary load from the forecast? Or was there kind of fixed assumptions on how you're varying outages and load from the day ahead?
We did not look at a lot of real-time uncertainty because of the thinking that a lot of that sort of change would be handled by the real-time market anyway. And so that's sort of, in a lot of ways, sort of already incorporated within the business as usual case. But definitely starts for units and sort of unit commitment for a number of units is one of the things that we mapped over. Another thing that we mapped over was any transactions that entities made for purchases and sales for sort of calculation of benefits, as well as as well as some features sort of within hydro. There was some flexibility in some places where it's more flexible and some places where it's a little bit less flexible overall.
Okay, thanks. And then otherwise, like in the day is like one of the main things was at least, I guess at least just in the EIM cases, like you're keeping some of those wheeling costs and things in place. Yeah.
Yeah, so in the EIM, we sort of take off the wheeling costs that are applied at the day ahead level.
Okay.
And so it sort of changes where it might be good to trade in real time versus day ahead.
Great, thanks.
No? Fantastic. Great job.
Thanks.
Oh, there's one more. I'm sorry. Okay, sorry.
One more?
Got to shout. No, I'm sorry.
Okay.
Just a quick question. In the
Yeah.
split case, what
Yeah.
did you assume for transmission between the two different regions? Did you cut it off or fix it, or?
So we allow it to happen, but we imposed a hurdle rate that was essentially equal to essentially the average of the wheeling charges of each of the participants there, as well as an additional frictional adder. And I think that's there's a lot of uncertainty with that because it's both, administrative cost of trading between zones, but also the risk that someone's taking on in that they don't know what your cost is in your own market, but you're making a sale and committing to make that sale to the other market that gets complicated and could, sort of have a little bit more risk aversion and sort of larger buy-sell spreads.
Okay.
What do you think?
Thank you.
Yeah.
Great job.